Turn over to our turn it over to our lead analyst in our consumer services area. Angie, you want to take it away?
Absolutely. So just again, to do a quick high level view of understanding reconstruction costs, these are the costs that um, are required to either rebuild a home or to repair a home that's been damaged with similar materials up to current standards. Um, and just basically getting you back to your pre-loss condition. This is where underinsurance can pop up, especially if you have a total loss of your home. If there is a large loss, meaning a whole community is lost, that's when you really see this underinsurance becoming an issue, because you're really stretching um, thin all of the resources that you do have available. So we can go to the next slide. There we go. So these are some of the factors that do contribute to your reconstruction costs. So you're looking at your local construction rates. Where are you? Are you close to these resources? Do these resources have to travel to get to you? And how do they have to travel to get to you? Material prices and availability. I think we all remember during COVID having some issues with availability of materials and those prices going up. Same thing with labor, availability of labor, building codes in your local area. Those are enforced locally, so that would be something that would come from your county level typically. And then your unique home features. So is this a custom home? Is this a home that just built standard, or is this something where you hired an architect or other professional that was able to really make it personalized for you? That's where you really want to make sure that you are communicating with your agent to make sure that all of those unique features of your home are reflected within your policy. All right, we can hit the next slide. All right, and so just a little more on the reconstruction costs. Are you in a mountainous area? Kind of going back to what I previously stated, how does the terrain around you and between you and resources affect you having access to those resources and those resources being able to get to you? Increased demand, and that comes from all different angles. There's more people in our state. There's higher costs. We have weather events that have become more severe and more frequent. And then, that's also affecting the availability of construction services and materials. Inflation is also a factor. I don't think we really need to go too much into that. Everyone sees the inflation from every direction, but that is absolutely going to be affecting the cost to reconstruct or repair a building or a property. Depending on what materials are needed, their availability, and again, how are they getting to you? So we're good. Next slide. And this is Bobby.
Hi. So understanding some of the insurance gaps that could occur in your homeowner policies. So when you're purchasing a policy or when getting ready to renew a policy, you want to talk to your producer about the replacement cost of the home. And so some of the factors that go into that replacement cost are your reconstruction expenses, as Angie just discussed. Those include, again, the labor, the building materials, overhead and profit for the contractors, for the general contractors. And then the features of the structure affect that replacement cost as well. So some of those include your square footage, your foundation type, the number of stories, your garage type and size, your interior and your exterior finishes. So if you have a home that is customized on the inside and the interior, you want to make sure that that's accounted for in that replacement cost estimate. extended replacement cost and the building codes or law and ordinance coverages. House Bill 231174 last year was enacted and requires the insurance companies to offer a 50% extended replacement cost coverage and a 20% law and ordinance coverage. These were previously 20% extended replacement cost and 10% law and ordinance. So these are extra coverages that you can purchase for an additional premium, but that premium is going to vary by company, and so it's definitely worth looking into to see how it impacts your policy. Additional living expenses, again, is another coverage that is included in your policy. Companies are required to include 12 months of coverage and offer 24 months of coverage. Again, that's another coverage where if you don't already have the 24 months, we would encourage you to look into that, because in the event of large community losses like the Marshall Fire, it's going to take longer to rebuild your home. Other coverages that you may not think about: water coverages, sewer service lines, sprinkler systems, water backup coverage. Those are things that typically might be excluded from your policy. So you may want to talk to your producer about adding those types of coverages, at least even like a $10,000 endorsement type thing. And then additional policies that may be available: flood insurance is purchased through a producer, but it's offered through the National Flood Insurance National Flood Insurance Program through FEMA. And earthquake coverage is an option. And then scheduled personal property. So one thing we hear a lot about right now are e-bikes. E-bikes are typically excluded from your homeowner's policy. And so to have coverage on that, you may need to purchase an endorsement or a schedule that item to your policy. That also goes for jewelry, fine arts, things that might have limited coverage in your policy, and to cover those items, you may need to schedule them. And then the last thing to talk about is loss assessment coverage with regard to HO6 policies and your HOAs. One thing that we recommend is that you talk to your producer about what your current policy covers. If it covers loss assessment based on the date of the loss, the date that the damage actually occurred, or does it cover the date the assessment is made? Because if you change coverage between the loss date and the assessment date, or if you sell your property between those two, there could be a significant coverage gap and possibly no coverage at all for that loss assessment. So make sure you read your policy and you work with your producer or your company representative to understand that coverage. Next slide, Vince. So when should you talk to your producer or your company about adjusting your policy? If you make home improvements or renovations, it is really important to reach out to them, particularly bathrooms, kitchens, finishing a basement, adding any additional square footage, whether it's outside and adding just a patio, and you have a covered patio and you add roofing square footage. And any specialty features. So then any updates you do on your home, if you replace your roof, make sure your company knows that roof has been replaced. You may have new roof discounts available. You may have materials, the type of material that you use may be available. If you upgrade to a hail resistant roofing material, companies may offer those discounts for those things. Plumbing, electrical, heating, and cooling, if those are updated, especially for your older homes, just let the company know. And then adding solar, you want to make sure you have coverage for those solar panels. So make sure you let your agent know that you have added that, and it may impact the amount of coverage that you'll need on the home. Next slide, Vince, please. So education and understanding, this is why we're here. We're here to educate all of you, to let you know that our goal here at the division is to empower you with the knowledge about what insurance policies will cover, how the insurance company, how the insurance policies work, and understanding the key to managing your insurance effectively. And most of that is going to come from talking to your agent, but we will provide you with some questions to ask your agent or your company. We provide resources to help you make informed decisions, and then to make those informed choices. Again, we're not going to tell you what you need to do, but we will give you some information to help you make those decisions and have a conversation with your agent. Okay, Vince, I'm going to turn it over to you.
Thanks, Bobby. Appreciate that. So on our website, we offer a number of resources regarding homeowners insurance available for consumers. We have information about the FAIR Plan, which Commissioner Conway mentioned earlier in this meeting. Regarding those meetings that we had last fall, we have a page dedicated to affordability and accessibility issues. That's where you can find those and a lot of other information regarding current issues. We have information regarding disasters and disaster mitigation, what folks can do and how best they can do it. We also are working on a number of legislative issues, and some recent things have been passed in the last couple of years. You can always go to the Colorado Legislature's website listed here and look up any bill passed or anything currently going through the legislature. These are a couple in particular that have passed in the last couple of years, as well as one that's currently working through. So that's always available. And then, of course, our consumer services team. As Bobby mentioned, we're here to educate, to help you better understand, to answer your questions. So those are where you can contact us via phone to ask questions, email, and then there's the website there where you can actually file a complaint. And then this is a new feature that we've added in light of all of the current issues going on, is a homeowners and HOA insurance toolkit, where we have information for homeowners, for HOAs, and for people living in HOAs. We provide information such as common terminology, resources, what's driving a lot of these premium increases, and then a whole host of frequently asked questions to hopefully give folks a lot of information so they can better understand the landscape out there. We hope we've covered everything, but we would love to get your feedback on this. You can see there, it's the same email address as the consumer services team, but if you have feedback on, oh, you didn't ask this question, this would be a good resource, those types of things, please let us know. This is going to be a living, breathing site that we hope to continually update with good information. And with that, I think it's important to then point out, as folks have any questions, concerns, complaints about your insurance company, or your agent, please let us know. Again, that's the Division of Insurance Consumer Services team, the phone number, the website, and the email address. That we can help. We can't solve everything, but we can surely look into things and answer your questions and arm you with more information to better navigate this world. And with that, I'll turn it over to Commissioner Conway to introduce our next guest.
Thanks, Vince. Before I introduce Amy, just a quick note about House Bill 24-1108, folks. So the title of that bill, as you saw, was the Insurance Commissioner Study of Insurance Market. But the bill really is designed to direct us to study the HOA market in particular and how to bring more affordability into the HOA market. So that process, assuming the bill gets through and the governor signs it, which we're very hopeful that the bill will get through and that the governor will sign it. Once that bill does become law, we'll start actually having stakeholder meetings to develop that study. We'll put that information out there for folks to come and give us their thoughts about what exactly we should study and how we should go about performing that study and putting the report together. We'll be putting the deadline for that report per the legislation is January 1st, 2026. But we'll be working to get ideas out there and solutions out there, obviously, as soon as we possibly can. All right, Vince, let's go jump to Amy. So folks, Amy Bach is the head of the United Policyholders. United Policyholders has been really a part of the recovery of all of our big natural disasters over the last, I don't know, decade or so, maybe even longer than that. Amy can fill in the gap for me. Amy herself has become, honestly, kind of a sounding board for me when we're working on different ideas and different issues. Amy is an incredible help in all sorts of different ways, and I'm very happy that she is here, and she's going to be here to share her thoughts with all of you. And one of the reasons why I think it's so valuable to have Amy and Brian, who's going to be presenting as well here in a few minutes with us today, folks, is this is, like I said at the beginning, this is an incredibly tough market. At one of the toughest, if not the toughest markets that we've seen in decades. We need people that have the ability to think outside the box, to find innovative solutions and to bring innovative solutions to us. Amy and Brian are that. And they've been, like I said, very helpful in the conversations that we've had up to this point. And I'm very happy that they're here. So Amy, I will kick it to you and you can take it away.
Thank you so much, Commissioner, and it's an honor to be with you. And a privilege to call you and your team a very steadfast ally with United Policyholders. That was not always the case, but once you came on as Commissioner, it's been so helpful, I think, for your citizens. So thank you for having me. And with you this morning, there'll also be a member of our staff offering some comments later in the program. So. Yeah, this is, if you talk to insurance agents, they're going to tell you that they've never seen conditions like what we're dealing with right now in the market. So the good news for you in Colorado as property owners is that you have an insurance commissioner and a team behind him that is on the case here. They have been on the case since conditions started to deteriorate in terms of what you already heard. You heard Jason talk about the reinsurance market and how reinsurers have started to get much more hands-on in telling their insurance company clients how to operate, who to insure, and what to and where and who not to, and also a lot of factors that are out of our control. And so we are here right now, as Commissioner Conway said, innovating. We are monitoring and we are innovating. So what I want to talk about today is just the basics of how do you as a property owner navigate the situation as it is right now, keeping your home insured despite more limited and expensive options, right? So those three photos you can see are three key points, illustrating three key points. One, we all have to be focusing on wildfire risk reduction, right? If you're a property owner, or you are a stakeholder in this ecosystem, now's the time to be hardening homes, creating defensible space, and trying to get as many people in the community to do it, because we have to convince insurance companies that the risk is better than they think it is, right? Part of what's going on is that insurers are scared. They have the risks that they had been insuring more blindly in the past. They now see in a magnified way through aerial imagery, data, modeling, predictions. All kinds of technology has made it all look much more vivid to them what kind of hazards are out there around your home. So that's a factor here, right? Technology is a big driver of what's going on, in addition to some of the other things we've been talking about. So what can we do? We can do everything we can to reduce risk. And then we can bring that to them and say, see, all this good work has gone on. Very important. We understand for a lot of households, that means they need grant funding. We're working to get more federal and state grant funding. I know Commissioner Conway and his team are on it in that area. In the middle, that's the reality for a lot of homeowners, is that they're getting priced out of home insurance, and we're trying to prevent that from happening for all of you. On the right there is the guidance that my organization has been putting out online since this problem started to manifest several years back. Next slide, please. So what is UP? You already heard a little bit. We're a 32-year-old 501c3. That means we're not for profit. We're a resource, an information resource for insurance consumers, and we're a voice. So when problems start to come up, we try to be there contributing with solutions. We've been active in your state since the 4 wildfires, wildfire, and then pretty much every wildfire since. We have brought our Roadmap to Recovery program to the impacted communities. We teach free classes. This is how to read your policy. This is how to know what you have. This is how to get all your policy benefits paid as quickly as possible. This is how to avoid mistakes with hiring the wrong people, or basically just how do you get through that process, right? So we've been doing that work in your state after disasters now for 14 years. Next slide, please. And after a couple of those past wildfires, we started to see insurers not dropping people in the area. And before Commissioner Conway took office, there was a previous commissioner. We did sound an alarm at that time and said, we really don't want to wait until the non-renewals become a problem. We want to keep a very close eye on the marketplace. And I can assure you that the Commissioner Conway and his team are on, again, they're on it. They are keeping an eagle eye and doing everything they can to try to keep insurers in the state, but keep prices where you can afford it, but also focus on risk reduction, because I think all those things have to happen. What are our goals? Help property owners keep your assets protected through policies that meet your reasonable expectations of coverage. We are working to advance and increase mitigation support and insurance rewards through premium discounts and assurances that if I move my beloved plants, if I take down my beloved tree, I better get rewarded, right? We're trying to make that a reality for you as the property owner. 3, we are monitoring the home insurance marketplace and gathering data. And 4, we're contributing to problem solving, sound public policy, and innovation and solutions. And again, some of your elected officials have been our important allies for us. Rep. Amabile, Kyle Brown, they have been champions along with Commissioner Conway in advancing the interests of policyholders in your legislature and in the regulatory arena. Next slide, please. So please take a few minutes to take this survey that we are running in Colorado with support from the department. It'll only take you it shouldn't take you more than 10 minutes. Just help us keep tabs. We are asking questions like, have you been non-renewed? If so, who did you find replacement coverage with? What was your premium before you got dropped? What is it now? If you didn't get dropped, great. Again, part of what we're all trying to do is go from a place of knowledge, not rumors, not fear-mongering, not panicking, but facts. Okay, so please do take our survey and help us monitor the marketplace. Next slide, please. So we've always been putting out tips for consumers. United Policyholders prides ourselves in knowing what we're talking about. We don't take money from insurance companies so we can have an independent voice, but we talk to agents as much as we can to hear from them what's going on with the products and all that. And of course, we talk to you. How was your experience? And we use what we learn from you. And these are the standard tips we've been putting out, shopping tips, through our Roadmap to Preparedness program for years. Comparison shop, have your grid with 3 columns, and don't just shop for the lowest price. That's what gets a lot of people into trouble with underinsurance. So focus on making sure you've got good coverage, right? Avoid underinsuring your home. I cannot emphasize that enough. If you talk to anybody who just went through the Marshall Fire or the East Troublesome Fire or any of the fires in Colorado in the past, they will tell you, our surveys will tell you, we will tell you. Commissioner Conway will tell you, too many wildfire impacted households find themselves underinsured, and it's too late to fix it, right? Not enough coverage on the dwelling. You heard Bobby's good tips. You see what the legislature has been doing to try to help you, making sure that insurers offer you that 50% bump extended coverage endorsement, the 2 years at least of temporary rent. Those are things that you want. Okay, so if you have the option to buy them and you can afford it, you want to buy them. You want to avoid underinsured. These are our standard tips. request a list of all the discounts the insurer offers, the alarm system, anything you might qualify for. Bundle, we didn't, you know, if you have auto, home, umbrella, put them all with one company. 5, this is a very standard tip that we've been giving for years. Avoid a company that you've never heard of, especially if they are what's called a surplus lines or non-admitted company. That is advice we've been giving. I'm going to tell you that we're shifting our advice a little bit now because of your marketplace situation, but that has been a traditional tip for consumers from us. Consider flood insurance. You all know after wildfires, you have a higher risk of flood. Your home insurance policy is not going to cover the mud flow. That's not going to cover flood damage. So consider it. Get a quote. Again, don't go on rumors. Your neighbor says it's a ripoff, what have you. Get a quote for a flood insurance policy and make an informed decision for your household and your situation. Increase your deductible, avoid filing small claims. That is a tried and true tip for affording your home insurance. Next slide, please. But now, with the current conditions, we've had to make some updates. 1, as soon as you get that non-renewal notice, and we hope, of course, you don't, but if you get it, start shopping right away. Don't bury your head in the sand and bum out. Start shopping right away. You have 60 days, thanks to legislation that we and DOI supported, that extended your time. You may need every one of those 60 days to replace your coverage. So that's 1. 2, get help from an agent, a professional agent. A lot of people have been shopping online. It's not as easy to shop online anymore for home insurance because your options are not as wide as they had been. So we are finding in areas where competition has been shrinking, it's more important than ever to find that agent that is on the case, that is proactive, that's not just sort of panicking themselves, that is actually looking for options. Now, a company you never heard of may not necessarily be bad, but you got to do extra homework, and you want that agent to know something about the financial strength of the companies that they might put you with if you've never heard of those brands. 3, reduce risk, mitigate. You already heard me say it. It's critical. Find out your risk score. That's a new one. A lot of most insurers these days are buying and using risk scoring programs like a credit score. Those scores have taken a much bigger role than in what your score is, has a huge impact on what your options are going to be in the market, what insurers will offer you a policy and what they're going to charge you. So just like your credit score affects what interest rates you get charged if you take out a loan, your risk score affects your property insurance options. So it's a newish phenomenon. So you want to ask your insurance company, did you base my non-renewal or my current premium on a risk score? What is my score? See what you can find out about what went into that score. And if there's erroneous information, like your address is wrong, or you're closer to a fire station than their records show, those things, if you can correct them, that may help you get a better score, which will give you better options. Okay. Another new one, understand your deductible options. Insurers have now implemented percentage deductibles, not just a flat dollar, not just like $1,000 or what have you, but now 1% up to 5% is common. So if you're insurer, just know what you've got and find out what your options are. That is that if you don't know what a deductible is, it's basically the amount of your loss that you're going to have to pay for yourself before your insurance kicks in, right? So the higher your deductible, the more you'll be responsible for paying, but the lower your insurance premium is going to be. So it's a trade-off, and you just need to make it thoughtfully. Then the next tip is consider all types of policy options, even a surplus lines company. What is that? That is a kind of insurance company that is less regulated. They are not protected by an insolvency fund. So if they run out of money to pay claims, there's no safety net underneath like there is for a regular insurance company. Their forms and their rates are not regulated. So Commissioner Conway cannot, he only has so much authority over a surplus lines company. So it is a lot more of a buyer beware situation. However, with the way things are right now in your market, and hopefully things are going to get better. You heard Commissioner Conway talk about the reinsurance market getting better. It is getting better. Hopefully, by the spring, the warmer part, we'll be seeing a little bit more of a break for you as consumers. But for now, you may not have a choice but to go with a surplus lines company. But again, it's all about working with an agent who can help you. And if you want to do your own homework on their financial condition, you can go to AM Best and you can research to see what their fiscal strength is. Okay. Next, no matter what, even if the prices are higher and that's putting pressure on your household to try to trim, if you can, try to focus on keeping your dwelling, your home, adequately insured for its replacement value, because people who've gone through a wildfire will tell you contents is important, but stuff is stuff. What really matters is having enough insurance to replace that home with one of like kind and quality. Next, beware new limits and exclusions for water, wind, and cosmetic damage. Insurers are on the warpath when it comes to water and hail claims, because they're getting more of those claims. They are trying to nip and tuck policy language to reduce and cap what they pay for those things. So again, you want to ask the good questions of the agent you're working with or the insurer from whom you're buying the policy, so that you're at least on notice, that you know what your caps are and they don't come as a surprise later, right? Cosmetic means insurers are if they add a cosmetic exclusion, they're going to say, oh, well, the hail damage is it's just cosmetic. It's not going to hurt the roof's ability to withstand water and weather. But people have different views on that. And from our perspective, you want to avoid a policy with a cosmetic exclusion. Trim non-essential coverage is the last resort. That is the most difficult updated tip for me to give you. I never want to say, after 32 years of trying to help policyholders not be underinsured, to then have to flip the script and encourage you to trim non-essential coverage, it hurts me hard. All right, next slide, and we're going to have to zoom through. What am I at time-wise, Jason? How many more minutes can I have?
You've got, I wasn't keeping track, but you've got another 5 minutes or so.
Okay, I'll just
Amy?
zoom through. So we already hit this one. Start shopping right away. Next slide. We're going to zoom. Get help from a professional. If an agent or broker tells you your only option is a surplus line insurance company, check with at least one other agent or broker, right? You're not going to have a fair plan until next year, probably. So again, you're just making do with what is now, right? It's not necessarily the dirty word that it had been in the past. The surplus lines company, they are the companies that take the higher risks, right? Typically, they were not really in the home insurance market until the last few years. So desperate times call for desperate measures. If you have to go there, just go there with caution. Next slide. We talked about this, create defensible space around your home and harden it. Seek out programs in your community that offer mitigation help or grants. Give the documentation to your insurer about the good things you've done to make it less likely that your home will be damaged or destroyed in a severe weather event. Next slide. It's so important. I just can't emphasize this enough. Now, even that shows you a metal gate. We don't, experts are saying you don't want to have a wooden fence attached to your home. It's kind of like a wick on a candle, right? Screening, putting mesh in front of any opening under your eaves or anywhere there's an opening, you want to keep embers from being able to get into your home. That's a major one. That's a cheap fix. Anybody can afford to do that. The more expensive pieces, having a Class A roof, removing combustible materials from under and near your decks, limbing trees, replacing wood fencing, some of those boxing eaves, they want to see between the ground and your first wooden shingle, they want to see at least 6 inches of no wood. Those things can be expensive. And that's where you may need some grant support. But, and then those little tips on the left there, I never want to forget to mention. Use your cell phone to create a video inventory of your home inside and out. And then call your insurer and get confirmation that you're adequately insured. Take notes. The QR code's not going to work for you in Colorado. This is, and neither will the RAP Resource Center. Those are California resources. But hopefully we'll be getting similar resources for you in Colorado as more energy and more resources are going into wildfire risk reduction in your state. Next slide, please. Find your risk score, correct errors. Next slide. Raise your deductible, but use caution. Do the math, be informed. What kind of a financial burden will it be if there's a loss at your deductible or slightly above it? Next slide. Consider all your options. Next slide. Try to keep your home insured for replacement value. Next slide. Talked about those limits that are new. State Farm has rolled out $5,000, $10,000, $15,000 absolute caps on water losses. If they're trying to sell you that and you can avoid that, that's our recommendation. And you know, that's just the reality of, yes, it's painful that that premiums are increasing, but you know, there's a certain level at which climate change is a factor beyond all of our control that we are all having to share the burden of. So, you know, you just are going to have to the best that you can, try to stay insured for the risks in your region. And that often can mean paying more than you would like to pay. That's sort of a fact of the current world. Next slide. Trimming non-essential coverage is a last resort. What are the two areas, contents and other structures, that feel like they're not the end of the world to reduce? Not all insurers will let you. That other structures is your garages, outbuildings, pools, and walkways, retaining walls, barns. If you don't have any of those things, of course, you don't want to be paying to insure them. But if your insurer will let you, you can often reduce the amount of your coverage for other structures as a way of bringing down the premium. Same thing with contents. You can reduce the amount of your contents coverage if the insurer lets you. A lot of them have these automatic percentages. Next slide. So that's it. United Policyholders has your back. When insurance matters, we are working arm in arm with the stakeholders in Colorado to try to keep options for you in the market. Keep our ears open. When insurers are talking, we listen. We are trying to keep your market competitive, healthy, but we are also working to build some options. I thank you so much, Commissioner Conway, and your team for working side by side with UP as these problems come up to tackle them. And thank you for the opportunity to be here today.
Yeah, thank you, Amy, for all of that great information. And as folks just saw in the chat, or if you didn't see it in the chat, I know we went through the last part of those slides quickly, but the slides, we'll be posting the slides on our website on that page that Vince went over earlier. So all of the information from the past meetings will be there, but these slides will be there too, including the survey that Amy touched on. So please, as she said, go in and take the survey and get us some information on those fronts. On the surplus lines side of things, it truly is going to be, I think, a key component for our marketplace moving forward. And in particular, it's going to be a key part of the work that we're doing in the HOA space. So it'll be something that we look at quite a bit. A lot of you that have HOA coverage now, you're probably insured through the surplus lines marketplace. You're very likely insured through the surplus lines marketplace. And there's going to be, I think, because that market has a little bit greater ability to be more nimble than the admitted market, I think what we may see more solutions starting to come through that marketplace as well, just generally speaking. And that is a good spot to pivot to Brian. So folks, Brian Bernier with the Professional Independent Insurance Agents of Colorado. We've worked exceptionally close with Brian and the folks at PIAC, the independent agents at PIAC, for years, along with Amy. I think the folks at PIAC were, the people, and Brian in particular, were some of the folks that were kind of sounding those alarm bells early on about the marketplace, not just in Colorado, but generally speaking throughout the western part of the country. I've come to know Brian very well. I've come to trust Brian implicitly. We have been, I think historically, we probably had referred, I don't know, 2 or 3 people a month to Brian and his team. we're probably doing that per week at this point, to give you a flavor of how tight the marketplace really is. But like I said, Brian, I trust Brian implicitly. I know Brian's gonna have some good information for you also. Brian, I will kick it to you, sir.
Yeah, Commissioner, thank you. Can you hear me okay?
We got you.
Okay, good. So first off, I know right now we're looking at the new online inquiry form. What is that for? When consumers they've exhausted all their avenues, they think they can, they've called all the agents in their area, and they still can't find insurance. There's an ability to go on to the DOI's website, click on this link here, the information will come to us. So the first thing I'll let everybody know is I don't sell insurance. We're not insurance agents. When you reach out to us, we're just trying to be a traffic cop and maybe help you kind of find a different place that maybe you haven't considered. So I know there's been a lot of talk on the surplus lines / non-admitted marketplace. Let me unpack what that is. I know most of the folks on the call have heard of a Lloyd's of London or a carrier or a kind of an avenue like that. That's what the non-admitted market is. There are some carriers on the non-admitted market that you probably have never heard of, and it probably might make people reluctant. However, Berkshire Hathaway, AIG, Great American, CNA, large multi-billion-dollar carriers, most of them have a non-admitted market of some sort. So when we talk about the non-admitted market, it is a necessity in Colorado currently. It'd be great to, not have to use the non-admitted market at times, but as the commissioner did mention, the non-admitted market can pivot a lot quicker and adjust to when kind of change, it allows it to pivot and move around as the market changes or fluctuates. So I will weigh in on one other thing as we talk about it. We have heard so many folks who have mitigated their property, hardened 30 feet, 40 feet around their home, cut the trees down, did the cement, the stone and whatnot, and still struggled to find insurance. So I don't want anybody this weekend grabbing a chainsaw, clear cutting their whole yard, and then calling up and saying, hey, I still can't find insurance, right? It's not just your yard or even just your small neighborhood. It could be your whole area. It could be look around as you drive around. And this is not for you to go knock on your neighbor's house and be like, hey, you need to mitigate. But having some community awareness of kind of what the mitigation efforts might look like is important as well too. So like I said, I probably talked to a couple hundred people who said, I did my part, but unfortunately, and we saw it unfortunately in the Marshall fire. A couple of little bit of mitigation efforts may not stop the spread of a wildfire. So that's important to know. So I think the next step is we're going to focus a little bit on the HOA situation. So Commissioner, is that fair? Okay. So we talked to the HOAs, and when I say the homeowners associations, I've spoke to close to 100 of them in the last year, from Durango to Telluride, all the way up across, all the way to the Springs. So even down in Trinidad. So we're pretty familiar with what the HOAs are feeling for the pressure. And we are fully aware that it's not a 20% increase. We're seeing 200%, 300% increases year over year. Okay. So some of the recommendations we're going to give to an HOA today. If you're in an HOA and you're on the board of directors, first off, you're crazy. But secondly, we know the work that they put in there. So what we will say is, every single HOA we've talked to, the board of directors has grinded, has called all over the place, has worked their tail off to try to find coverage. So, and they still do get some board members who are pretty vocal about, hey, how did this happen? We found it's not something that the board of directors has done. It's just the marketplace we're in. So that's the first thing we'll talk about. Secondly, what happens traditionally is if somebody's going to see their HOA dues rise dramatically, or they're going to see a large assessment, what they start doing in their HOA is they start calling around to different agents all over the state. If you do that with 15 or 20 people in HOA, the process becomes extremely fragmented. Okay. What do I mean by that? Is if 4 or 5 people call a couple different agents, and those agents approach carriers or approach brokers or surplus lines type markets, they start bumping into one another. And then that submission or kind of the discussion kind of loses a little bit of luster because they know that the people are shopping everywhere. So what we have recommended is, traditionally we say create an insurance task force for the insurance renewal. I hate to use the word insurance committee, but I think an insurance committee might be appropriate for the next 3 to 5 years. What we think about is the group gets together, because once you get your new policy, you want to start thinking about your renewal. You want to start thinking about some things that you guys can do to mitigate both the cost as well as the HOA around there. So what do I mean by that? Can you take a higher deductible? Can you, versus $25,000, which is pretty low if you have, let's just say 50 units, $25,000 deductible in the event of a total loss, each person was throwing $500. That's pretty low. We take that $25,000 and increase it to $250,000 to see some reduction in premium. If you break it out and you start doing the math out, we've done this with a couple of them and saying, hey, take on as heavy a deductible as you can. They know full well that there's not going to be a claim filed unless it's a pretty big claim. And I know that we use the term, hey, then why do I have insurance? The insurance, if you have a $10,000 or $15,000 claim, or even a $50,000 claim, I might sit together as a group and decide, do we file that or do we just pay that out of pocket? And, in each case is different. I think I have to say that as a disclaimer, but I would really strongly consider none. So, with all that being said, in the HOA space, we've heard about the FAIR Plan, right? The FAIR Plan is going to be a tool for insurance agents to help those in need, right? The limit for the FAIR Plan on a single family residential dwelling is going to be $750,000, okay? And the limit, and by the way, this is in statute. This is what the lawmakers passed. So this is not the FAIR Plan Board of Directors. This is not the commissioner. This is what the statute says. And then if you live in an HOA, for this discussion, an HOA is considered a commercial lines product, right? So you would have up to $5 million in the FAIR Plan, okay? So 750 if you own a home, $5 million if you own an HOA or commercial type building. So with that being said, in the instance, if your HOA total value is under $5 million, the FAIR Plan would be a tool. I know we talked a few things about gaps in coverage. The FAIR Plan doesn't include liability insurance. However, with that being said, we have found a handful of carriers who will pretty easily write liability coverage on an HOA. The property is really the sticky wicket here today, which is a kind of a difference from what it was 30 years ago, where liability was difficult to find and the pendulum swings back and forth. So the FAIR Plan, for those who are saying, hey, here it comes, it's going to solve all my problems, it's going to be a Band-Aid on a situation, and it's going to help. It's going to be a tool. Is it going to solve everyone in the state's problems overnight? No, it's not. We've talked to HOAs in the last 3 weeks. One has $1.5 million, and they're in a high brush fire area, and another one was $180 million in total insurance value. I think you guys can all see that $5 million isn't going to do too much. So what we've heard from a couple of HOAs, a handful of them, and you're going to get the thoughts of Brian, the opinions of Payak and whatnot, is I know some HOAs have said, hey, we got 50 units. Everybody go buy their own homeowners association, homeowners insurance. We have, and I have, again, 26 years in the insurance industry, shared roof, shared walls, shared everything. We think that the claims process, if everybody has their own separate insurance in a building that shares roof lines and a building that shares walls and everything like that, is going to be probably a mess. And that's just our opinion. Each carrier is going to probably adjust differently. And we think that that situation is going to be a little bit sticky. So we, as an organization, are not advocating for people to do that. It sounds great on premise. We did this exercise with about an 80-unit HOA. We've said, okay, everyone goes out and buys their own insurance. They all added it up, and then they had to go buy insurance for the common areas, for the clubhouse, etc. The cost was almost 30% higher net for everyone to do that all on their own than it was to have the right proper coverage. The other thing we've heard, some folks and some attorneys have recommended, if you have 6 or 8 separate buildings in your HOA, or 15 or 20, to break that up into 10 or 12 different homeowners associations with sub HOAs. Again, we look at things from a logistical standpoint. You're going to need 8 to 10 D&O policies, which is directors and officers coverages, 8 to 10 sets of bylaws, still have common areas, still have common liability, etc. So We've heard that as a way to try to get ready for the fair plan and get under the $5 million limit. And again, I can't sit here and say that's a really good idea because we just don't know how it looks. I'm not an attorney, but we see stuff like this occurring and we're like, okay, we could just imagine a scenario where someone comes on the property and slips and falls and everybody's pointing fingers to the sub HOA. So those are some of the things that we've heard about on the HOA front. Like I said, we have had one, maybe two now, who said, hey, listen, we have to assess everybody, probably 5 or 10 grand for this year. They've set up a model where over the next 3 years, they'll be able to put enough money in reserves to probably take $1 million or $2 million deductible in the next 3 years, with basically self-insuring anything under that $1 million mark. They're going to see some premium reduction year over year this year, which is shocking. They're going to save about 10% because they're at a $500,000 deductible now. And then the next year, they think they can get it to that. So HOA increases, HO dues increases are common. Again, we don't want to see them going up from $500 a month to $4,000 a month. I think I don't even need to see a simple nod from the commissioner, but that's not I don't think that's healthy at all. So that's going to drive people out of their homes and we don't want that. So sitting down as a group, building that insurance task force or insurance committee and really focusing on it, hiring or engaging with a really good broker who knows your area. And again, on the HOA front and even on the homeowner front, I really think it's important to do business with somebody who may be local to Colorado. They know the marketplace. Some of the online stuff, you might find coverage and then a week later you might get non-renewed. So we don't want that either. So there's enough agents, and I think there's probably 4,000 licensed agents in Colorado. So there's plenty of people to help out. This form, like we started off with, if you're really in dire straits and you haven't found anybody, click on it, fill out the information. Out of the corner of my eye, I'm already seeing one come across. So we're here to help you, and it might be an introduction. It might be a little tips and tools. And again, we're not an agent, but we're here to try to make it as painless as possible. Proud to say the commissioner said that we're used to get 2 or 3 a month. We're probably up to 5 to 7 a week right now. We have helped probably on the HOA front, probably 98% of them find coverage. I will tell you, we have a huge affordability problem on the HOA front. There's not a huge availability issue. And I know the two of them kind of go together, but there's coverage. Now, whether or not that's affordable is a whole separate discussion. The homeowners front, it's rugged on some areas. For those folks who live in the Pine, Bailey, Evergreen, that corner of the state, that might be one of the hardest parts in the country right now to find insurance. We keep hearing from them. That whole area is just really, really rugged right now. And we wish we had an answer. Our members who service that area call us and say, there's nothing up there, even on the non-admitted side, when you get to the higher brush fire scores and whatnot. So I'll stop there because I know there might be some questions about the FAIR plan, some questions about the HOAs. And again, we're here to help as well too. I know the Department of Insurance, and I'll echo Amy's comments from earlier. We have a very forward-thinking department and a very forward-thinking commissioner who says, this is not fun for anybody, but if we all work together, and I think we can all say, hey, listen, the industry is working with the Department of Insurance and vice versa, and we know there's a problem, and we're just all trying to hold on until we can get some really good solutions in place. So I'll leave it at that because I know that some folks might have a question or two, and we're more than happy to answer those, or just fill out this form and we can talk outside of this meeting if it's a very specific matter.
Thanks, Brian. So just a few quick things, folks, about to touch on a couple of things that Brian talked about. So the FAIR plan, and Amy touched on this as well. So we're pushing the FAIR plan, and we've asked the board to do everything that they can to have policies available by January 1st, 2025. And I know that feels like that's a long ways away, folks, but that this legislation was passed last legislative session in 2023. The governor signed it into law, I think in July, it might have been in August. he got the board appointed. The board was finally appointed. The last person was appointed in November, and then we had to fill one more seat in December. I give you all of that background because what this board is doing, they're standing up a new insurance company, and they're standing up a new insurance, effectively, they're standing up a new insurance company in the span of roughly a year. And they're doing a ton of work in order to get that done. And I'm incredibly thankful that it does look like we're going to be able to hit that January 1st, 2025 date. But the other component that's really important to keep in mind, folks, when it comes to the FAIR Plan, it's that affordability versus availability issue that Brian just touched on. The FAIR Plan is going to be a solution. It's a tool to help us address availability issues that we have in the state. It isn't a tool to address affordability challenges. We have to find other innovative new ways to address those affordability challenges. And we're working on that. Our counterparts in other states are working on that. Different ideas to build reinsurance programs. There's all sorts of ideas that are floating around out there that will truly help us on the affordability front. But the FAIR Plan is designed and it's intended to be a solution for that availability piece, and that's really important to keep in mind. The other piece that I wanted to touch on that mitigation front. So Brian's right. Don't go out there and start clear cutting your yard. It is something that we need to address, however, and we need to be able to get you all better information about the types of mitigation that are going to truly have an impact for you and move the needle for an affordability component. Right now, I don't think that we do a good enough job. And when I say we, I mean both the division, but more importantly, the industry. We don't have enough information out to you all about what mitigation works and what we mean when we say that we need the community to mitigate, right? If we're going to be asking communities to spend tens of thousands, hundreds of thousands of dollars in order to mitigate their communities, we need to be able to tell them what the return on investment is going to be. So I've been harping about that for months. You're going to continue to hear me harp about that every chance that I get. And it is going to be something that I continue to ask the industry to step up on and help us find solutions for, because it's not, from my vantage point, we have for decades been talking to communities about mitigation and how important it is to mitigate, but we're not doing a good enough job of explaining to you all what your return on investment is. And we're going to start to find solutions for that front. All right, let's jump to questions. The first person that I've got up is Tom McGimsky. I'm sorry, sir, if I butchered your name, but I'm guessing I was somewhat close.
No, thank you very much. I do appreciate it. And thanks for this presentation. It's been very helpful. And I've already kind of copied all of the discussion points on HOAs on your website. So my question is for Brian, and it has to do with HOAs. I've got a unit at an HOA that saw a 5x increase of premium year over year. And I believe they went to a non-admitted insurer. But Brian, if I had some other additional questions, and you mentioned this, that, hey, don't clear cut, don't, hit all the insurance, providers, have a more, I think, strategic approach. Can I reach out to you and just run some ideas by you, or at least get your thoughts?
Yeah, Tom, and yeah, absolutely on that jot form that was on there. By all means, do that. We try to get back within 24 or 48 hours. I think I do pride ourselves on, myself especially, on pretty quick return, because this is people's most important asset, right? This is their home. So we try to get back as quick as we can and try to be responsive. So by all means, yeah, 100%. And I know that you traditionally, and we can really address it quickly, most likely they had to build a tower to get to certain limits. Like one carrier will take 5 or 10 million, another carrier will take 5 or 10 million. And you can imagine that when you build up 3 or 4 or 5 different insurance companies, it starts getting really expensive, and there is some stuff. But we can absolutely talk to you what you have. What we're not going to do is tell you, I'll call this agent or call that agent. We'll say, here's a couple of agents who've done a good job in your neck of the woods, and kind of go from there. So, and when I said don't clear cut this weekend with the chainsaw, by all means, you're still going to get the dead slash out of there. You're still going to continue to clean up the area and stuff like that. So there is a fine line between,
Got it. And so thanks for putting the, is this the link to fill out the form to have you call back, or?
I think so. Yeah, I don't have any control here. I never have control. So, yeah, I think that's the link. Yep, 100%. So fill that out. Let me know when it's a good time to chat. We're more than happy to do that with you. Yeah.
Got it. And are you seeing the reinsurance market get a little bit better? We
Yeah,
have to
it's
bind
loosening up a
coverage
little.
in,
It's loosening up a little bit, and the DOI and everybody on the phone, we're knocking on wood. If we can avoid, I mean, keep in mind, one other thing is, we talk about the wildfire. We also have a raging hail issue in Colorado too, and that has catastrophic storms, at least 3 to 5 times a year of 25 to $50 million in losses. So we have two issues on us that are kind of creating this situation. So while we can talk exhaustively about the wildfires, there's still a hail issue that, unfortunately, hardened roofs, higher deductibles on your roof, the hail still wreaks havoc on the Front Range too. So
Yes, but yeah, Tom, so we're hopeful that the reinsurance market will continue to loosen up. If we start to see interest rates come down, that will help the reinsurance market loosen up too. So there's a lot of different factors that are going to come into play, but we're hopeful, I think is the best way to say it at this point.
got it. Yeah, our HOA is in Louisville. We didn't have much in the way of damage. But having said that, the premiums went up nonetheless. Well, thank you very much. I will fill out that form, and Brian, I look forward to talking to you.
thanks.
Thanks, Tom. All right, Chad Otto.
Yes, hi, thanks. I've been an agent here in Denver for 30 years selling homeowners insurance, and my topic is definitely on the wind and hail part of this. I'm already seeing at least one insurance carrier in Colorado renewing many of their policies with a 5% wind and hail deductible as the only option. That essentially means that they're not covering any hail damage to a roof. That's what happened to the HOAs several years ago. Deductibles started going up to those extreme levels. I also have another carrier that is now restricting loss assessment coverage to just $2,000 of the deductible of the loss assessment if the deductible is the reason for the loss assessment, the HOA deductible. And so if this continues, we're going to have people that are not going to be able to afford to live in their condo or townhome or their own single family home because the premiums will get to a point where they will go to the 5% wind hail deductible, and then hail damage is going to occur and they won't have the money to replace their roof. And so one of the things that I think the question needs to be answered is, in most cases, does a roof really need to be replaced after a hailstorm? And if so, how long can that roof go and still shed water as it was designed to do? And I think that there's a real possibility that we're replacing roofs immediately after a hailstorm that might last 5 or 10 years and still shed water over that time frame. And so if we're really going to talk about lowering insurance premiums and making it affordable, I think we need to revisit or visit, maybe for the first time, the practice of replacing roofs and say, hey, maybe it's really not necessary to replace a roof, because I've had policyholders go 5 years or even one case 10 years after a hailstorm before they actually replaced the roof and never had a water leak. So that's one thing I would love to see studied by the Division of Insurance is, are we repairing damage
Chad,
that doesn't really need to be repaired?
Let me jump in there, Chad. So as a general rule, I think it can be dangerous to set ideas or kind of benchmarks based on anecdotal stories, but anecdotal stories can absolutely be informative. We're not roofers. We don't have the expertise to study when roofs are to really make that kind of loss analysis of when roofs absolutely have to be repaired. I do think, however, that there are absolutely ways for us to learn lessons, and we talked about it some of those meetings over the fall, to learn lessons from other states about how they have actually gone about hardening roofs and hardening homes just in general, and starting to use that as a mechanism to control costs and replacement costs, obviously, because if we can harden roofs, if we're replacing fewer replacing fewer roofs, that will have a downstream impact on the premium. So I think we're thinking about similar things, Chad, of how we can go about replacing fewer roofs. I don't know that we'll ever be at the place where we would be advocating that we should, after a hailstorm, if there is damage on a roof, that we would be in some way stepping in to make a determination as to whether a particular roof has to be repaired or replaced. But I hear you completely that we need to find innovative ways to find solutions for our affordability challenges for sure.
Yeah, I think it would take legislative action in order to really accomplish what I think could be done. But I do think the Division of Insurance could bring in professional roofers and get their input and their opinions and so forth on this
Sure.
to help support potential legislative action. And I also think too that if we don't do something and more people go to this 2, 3, 4, 5% wind hail deductible, I think in most cases that actually violates their mortgage, their loan agreement, that the deductible is far too high for the mortgage that they have. And so I think that is a potential hotspot that hasn't surfaced yet, but very likely could in the future.
Thanks for those thoughts, Chad. All right, let's go to Lisa Hughes.
Oh, hi, sorry. I was muted. Yeah, I just wanted to echo what Amy said. I'm also on the staff of UP. I lost my house in the Marshall fire, and this has been really helpful because I also own property in Grand County that is part of an HOA. So I just wanted to say that what she said about underinsurance is extremely important, and please try to get the amount of insurance you can to replace your home, even if you do have to cut in some of the other areas that she mentioned. Contents or other structures. Also, and that, you know, I appreciate you working on these issues, the insurance, that the DOI is working on it. And, you know, we're continuing to work on it as well from the UP side. And then just as a resident of Colorado and a person who's in an HOA, I have a question from Brian. I thought your comments were fascinating. And I'm wondering what you've seen with HOAs in regards to bare bones policies. I'm not going to name it, but the HOA that I am in a mountain community, is actually having a meeting this week where they're discussing with the homeowners going to a bare bones policy where they would just do, you know, walls out and we are responsible for everything else. Because of mostly water claims, but other things too. So I just wondered what his thoughts were on that.
Yeah, Lisa, we've seen every iteration of a way to save money. And again, to that point, and I don't want to get too technical, there's an HO6 policy, which is that's your condo policy, for lack of a better term. And you'll have to, if you guys change your bylaws to go, walls out, still covering the roof, still covering all the siding, that goes back to my point earlier that, yeah, you could do that. You'd have to increase your HO6 coverage to cover everything on the inside of the unit, kitchen, walls, drywall, etc., plumbing. So yeah, I've seen some people do that, but like I mentioned earlier, some of the folks who've done that increased all their HO6 coverages. Net cost hasn't changed too much, but yeah, that's definitely a mechanism I've seen some HOAs use, but traditionally that is a bylaws change. But I can't speak again. I'm not an
Right.
attorney.
No, I think it is going to be a bylaw change, and that's what they're
Yeah,
asking
we've
us.
seen that. Yeah, that's logical. I mean, by the way, not in some HOAs do that from the formation wherever you are in the country, which doesn't have a law. They do that because that's just the way they want to do it. So that's not uncommon at all. It's becoming more common when people say, okay, how can we maneuver? And it gives some people the ability to shop around a little bit. But again, whatever the cost is going to be on that, you still need to get an evaluation and done properly. I mean, especially in the mountains or in Grand Lake where labor is a little bit harder to find. Yeah, good question.
Thanks, Brian. Thanks, Lisa. All right, let's keep moving. We've only got 10 minutes left. So, Mr. Bauman, you are up.
Hey, good morning. I have a question regarding law and ordinance coverage. My home was a total loss in the Marshall fire. But first, I just want to check my understanding of how I define law and ordinance coverage with respect to how you guys would see it. So I've come to learn that law and ordinance coverage is the difference between building my previous dwelling according to the 1991 codes and then the cost to build my previous home to the 2021, and I have to build to the 2021 IECC codes. And so if that's correct, it appears the insurance companies do not have any way to adequately or accurately calculate law and ordinance coverage. And what they typically come back to me with is they say, well, the typical homeowner, their law and ordinance coverage is X. And I'm fortunate to have a very large law and ordinance bucket of money, but I can't seem to get all of the money that is coming with respect to how expensive the 2021 IECC codes are in relation to the 1991 codes. Any advice on that?
So I don't think, Bobby, you want to jump in with thoughts?
I'm not sure I can answer that right now, but I mean, so the law and ordinance coverage is paid when it's incurred, right? So I don't know that you know, you have the bucket of money, and I don't know that the companies are going to be able to tell anybody exactly how much they're going to need based on that their local codes. But as you're incurring those, you should be submitting them to the company, and they should be paying that. So I guess I'm not entirely sure I understand your question,
I think it's,
or if I'm answering your question, I should say.
yes, yeah, Mr. Bauman too. I think on top of that, it's not necessarily accurate that the difference that the law and ordinance coverage is the bucket of money won't be equitable to the difference between the 1991 code and the 2021 code. It'll be the difference between what your home was built to, right, when you purchased it versus what it would take to get to the 2021 code.
Yep.
So if there's going to be a number of different factors that'll come into play, to Bobby's point, that I think it'd probably be easier for us to help you kind of walk through if we have more detail than we're going to be able to get into at this point.
All right, I'll reach out privately then. Thank you.
Yep, absolutely. All right, Cheryl Bowdridge.
Hello, thank you. I wanted to just follow up with when they were talking about the FAIR plan, and they were talking about some HOAs have split off into sub HOAs to reduce the amounts per HOA so that they could get coverage under the FAIR plan. I missed what my phone broke up a little bit, and I missed what he said. Did he say then the HOA as a whole was ensuring like clubhouses and common areas, that kind of thing? What was that comment?
Yeah,
Cheryl,
so
go ahead, Brian.
Oh,
Before you jump in, let me just, so Cheryl, before Brian jumps in, one point of, I think, incredibly important clarification, and it's what I touched on about the FAIR plan too. The FAIR plan, if folks are doing that, if folks are trying to break up their associations into separate buildings in order to try and get coverage under the FAIR plan, it's not clear to me that the FAIR plan actually will allow that. Then that's going to be part of their articles of incorporation. So we'll work through those issues. But more importantly, it's not, again, the FAIR plan isn't going to be a solution for an affordability challenge that you're having out there. If the marketplace, if there is coverage out there, it's likely going to be the case, even if the coverage is more expensive than what you were paying for previously, it's probably going to be more affordable than what the FAIR plan coverage would be. But Brian, go ahead and jump in.
yeah, sorry about that. Yeah, so what we have seen is, let's just say there's 5 separate buildings. You still have the parking lots, you still have the open areas, you still have the clubhouse or whatever, garages, etc. We found it wasn't really logistically possible to say, okay, HOA A has this and stops here, and B, we've kind of seen it got a little fuzzy as they try to go through and define what each one of those. So again, I'm not an attorney, but at the same time, just from a feasibility standpoint, you're gonna need separate DNO policies, separate bylaws, separate meetings, separate minutes,
Right.
separate everything. Yeah, it's just gonna get really sticky, I think, going through that. And again, some folks have done it and said, hey, this is the greatest thing ever, but I would challenge that when a claim occurs. So anyways.
Okay. And then I guess just to follow up, so would the FAIR plan, and this might be for Brian, would the FAIR plan be a better way to go than a surplus lines? Like, because right now we have an HOA that's only covered under surplus lines insurance, and I'm a little bit nervous about renewing it. And I'm just wondering, if we can't get anything but surplus lines, then is the FAIR plan a better coverage than the surplus lines insurance? Do we know that yet?
Yeah, no, I can't speak intelligently about your exact policy, but traditionally the FAIR plan is a bare bones coverage to cover a structure, and there's no liability, there's no enhancements to the policy. It covers the, you know, the 9 basic perils. So I would go on a limb real quick, but I'm more than happy to talk to you outside of it, that you're gonna have a better policy in the non-admitted market. And again, I want to take that non-admitted, people think it's, trust me, the non-admitted market can be pretty robust when it comes to coverages and enhancements and whatnot. So
Yep.
yeah, so I just want to be clear. Most likely you'll be better positioned with the non-admitted market. But again, your
Okay.
agent will be able to sell the FAIR plan when it's live, when it's up and running. Probably, I would say by October, November, they'll have an indication of that. So,
Okay,
That's right. So Cheryl, I'm gonna
thank
keep
you.
going. Thank you, Cheryl. I'm gonna keep going. But it's probably the case, Cheryl, there's at least a decent chance that you were insured, your HOA was insured through the surplus lines market for years. It's probably not something new. But I'm gonna keep going. And I'm not gonna try and get your last name because I'm probably gonna be terrible with it, but you're up.
MZ, and I'm with Rotary Wildfire Ready in Conifer and Evergreen. We have been looking into the ratings companies and finding that they are a significant part of what's driving the increases in insurance rates. And they have major errors in their criteria. Some of them don't publicize their career criteria and won't give it to you even if you ask them. It ranges from individual houses, where in Jeffco they're saying houses have shake roofs when they've been outlawed for 25 years, to Conifer, we're getting our wildfire danger from Denver when it comes from the southwest. They're not looking at wind. We really need a major study of these ratings companies and what criteria they're using and to get them accurate. And I would like to ask whether this is something the insurance division can do, or do we need to ask the legislature to create such a review?
So, Ann, one of the things I've talked about quite a bit recently is just transparency in general around the rating companies, and I think we're getting a lot of feedback from you. So, if you could go on mute, it would be helpful. So transparency around the mitigation, transparency around the scores just in general. I do think it's going to be a key part of the conversation. I think it has to be a key part of the conversation moving forward. I do, however, also think that it's probably going to require legislation in order to really actually kind of get the robust type of transparency that I think we all need in order to answer some of those questions and make sure that, especially when there are errors, that consumers have the ability to make sure that those errors are fixed. Because right now it's not clear to me that that is a simple process at all. I'll at least say it that way. So I think there's a lot of work to do on those fronts. And I think you'll hear us talking about it and having conversations about potential ideas that are going to be floating out there. And if you all have some ideas, as you heard Brian touch on, your neck of the woods right now is one of the hardest parts of the country really to find coverage. So if you all have ideas, we definitely want to hear them. But thank you, Ann, for that thought. Reach out to us. We'll have more conversations. All right, so Mr. Kincaid.
Yes, thank you. The Colorado Supreme Court recently ruled on the Gregory and Runkle cases, which had to do with the notice prejudice rule. And my understanding is that what that is in the insurance policy, and this is just, I don't know whether it would apply to HOAs or not, but for individual dwellings or houses, that if you don't report the hail damage within a year of the happening, they don't cover. And, I understand that's probably not illegal, even though the Colorado Supreme Court, they ruled in favor of Gregory and Runkle on this. And I was just wondering if you had any comment on that, because that's, I'm sure, affected a lot of people that have filed a claim and have been denied.
So, Mr. Kincaid, I'm not familiar with that opinion. I'd want to obviously go and take a look at it and understand what the court said before I shared my thoughts on it. But it's certainly something that we'll do, and we'll if there's something that's applicable, we can have some conversations.
Okay.
All right, thank you, Mr. Kincaid. All right, Ms. Goslova, if you have a quick comment, so we're over time.
Okay, Daniela Gosolala from Granby in Grand County. I will recap it. Just want to say that there is an enormous gap between the risk scores that insurance company coming up, and from actual risk that from the practical standpoint. For example, I can lower my risk scores in insurance company and burn lots of energy doing so, but it does nothing to lower my actual risk to lose the home. So the fix is for Commissioner Conway to look into these algorithms of these attachments, create the risk scores a little bit deeper and from the practical standpoint. And I think this will address lots of questions that people before me had.
No, thank you for that comment. Like you said, I think we've heard that from a few folks, and it's definitely something that we've talked about separately too, as something that we need to get more clarity on and more transparency on at a bare minimum, so folks understand it and that we can find ways to solve for the problems in our marketplace. All right, folks, we are a couple minutes over, so we're gonna leave it there. But thank you all very much for being on. The slides will be up. The recording, we started a little bit late on the recording, but yeah, I think you just really missed my opening remarks, and those didn't really matter. So the good stuff, the important stuff, will be in the recording, and the slides will be up. Both a link for United policyholders and Brian's link to his form to contact PIAC as well will be included in that. You've got our contact information here as well. So thank you again, folks. Really appreciate everybody being here today. Take care.